Hi, and welcome back to Channel 11. I'm your host, Ken Shinoda. Today is Tuesday, July 7th. We're going to review the month of June, and I guess yesterday, because we had a little bit of World Cup disappointments and Mag 7 disappointments over the last 30 plus days. So broadly, the index kind of going sideways here, close to an all-time high. Generally, the direction's been up, so it's turning out to be a decent year from equities. As we look at year-to-date, momentum, industrials, and energy, infotech really leading the way. Also a little bit of materials and real estate playing catch up. I think that has to do with all the CapEx that's going on from the big hyperscalers. It's funny, Mag 7's kind of flat on the year, and the stuff they're buying to build the data centers, that's been ripping, like chips and semiconductors and things like that. And then we can see on the far right, year to date, still positive return, consumer discretionary, financials, communication services, and healthcare, the laggards, only in the single digits. On the month, energy down with the drop in oil, as we've seen the Strait of Hormuz open back up, and we see oil flowing, WTI actually sub 70 for a brief moment. Equity performance with the big weakness in the yen, the Nikkei in dollar terms up huge, 40% returns, just 8% on the month. Dow Transports, EM doing well again. Russell 2000, the small caps playing catch up, and so the laggard here is UK, and even Europe's played catch up recently. Has to do with oil coming down with the heavy manufacturing base of the European economies. You're seeing a little bit of a recovery there. Europe was definitely lagging, but lagging, but still up 9% for the UK, not so bad. S&P 500 up 10. Here you can see Mag 7 kind of just been going sideways from January, barely up from a price standpoint. Seen with Mag 7 doing poorly, which is such a large part of the S&P 500 now, you're seeing equal weight do well, being one of the top performers out there. Here you can see that graphically. S&P 500 in the dark blue, the red is the equal weight, and so that really kind of took off in the month of June. We've got the Fortune 500, and you can see that blue line is at the top, and then Mag 7 at the bottom, kind of barely up on the year. I think it might be time for Mag 7 to play catch up. Basically, what's happening is earnings growth is kind of, people are expecting disappointments there from all this CapEx. In the meantime, the stuff they're buying to build the data centers are on fire, and you've seen exponential price growth in kind of chips and some of these companies. If you look at the semiconductor index. But at some point in time, they're going to start making money off this stuff, and they've underperformed so much. You would think there's going to be a rotation out of the expensive chips and things like that and into Mag 7. So I think that might happen. Mike Wilson over at Morgan Stanley has been talking about that. Crypto, bear market, Bitcoin peaked close to 120. It's been sliced in half every 5 years. They say it halves. Also weakness, even more weakness in Ethereum, Dogecoin, basically dead, it appears. Kind of seeing a floor around that 60,000 area, but I think, you look at what's happened, the Fed is not going to be cutting rates. People are a little bit less worried about inflation. Gold's come down into the low 4,000s, and Bitcoin, which some people say is the new gold, even though I joked a couple Channel 11s ago, gold is the new gold, because gold's been working and Bitcoin hasn't until very recently. But something to watch. It's markets speculation, I think, also feeds into Bitcoin, so it's good to follow that. Here you can see gold and silver both down, kind of catching a floor here in the 4,000 area. I think if the Fed gets dovish again, which I don't think happens immediately, but there's a possibility that I think they don't hike the way the market's pricing in, and then you could see maybe gold catch a bid from here. But I think gold probably goes sideways, finding some support around that 4,000 area. Here you can see that just crazy difference between, this is not megacap tech. This is now the semiconductor index versus the S&P 500. Huge outperformance by the semiconductor index. A little bit of a pullback here, and then you can see that the AI is going to basically kill the software companies, and that's been struggling. Kind of saw a dead cat bounce for a little bit, but back down to the kind of the lows there. And here you can see that just looking at the different stocks. Salesforce in the top left, a little bit of a dead cat bounce in June, and now making new lows. Adobe, Intuit, ServiceNow, these all kind of look the same. International equities have been doing well, especially in Nikkei with the weak yen. And yeah, it's hard to be upset if you own these things right now. It's been a good market for equities after what people thought would be a troubling year with the start of the war. But with the Strait of Hormuz opening, energy prices coming down, equities have recovered. Europe, make Europe great again. Europe started with some big outperformance in 2023, but again, with what was going on with the Middle East and the spike in energy prices, it definitely was lagging the U.S., but catching a bid now as oil prices drop. Here you can see the euro kind of dropping because the dollar's been doing better with the rate cuts being priced out of the market. Here you can see that rallying the dollar. We got down to kind of 97 handle, and pretty good rally, three plus points up to 101 area. Seems like it might hit some resistance up here in that kind of like 101 area, and it's all going to be about the Fed and the next meeting with Warsh, and if he's going to be hawkish, dovish, or neutral, and that'll be, I think, a driver of the direction of the dollar. Obviously, interest rates will drive the dollar as well. Here's the yen, weakest, I think, going back now, one of the weakest levels ever. I used to travel there a lot in the early 2000s to visit family, and it used to be back at like 75, 65, 80. It's 50% cheaper now. Pretty remarkable. That's why tourism has been doing really well there. Commodity index, big reversal. This is all oil and energy. Saw that huge rip higher, coming back down, probably bounces off that 200 moving average. Seems like oil's stabilized here around that $70 plus or minus range. But there could be a lot more supply coming, and China demand has not picked up. Was reading about that this morning. So something to follow, I think, is look at oil futures to see how they're behaving relative to spot oil. And if they're lower or higher, right now they're lower because the market's expecting more supply. Here you can see commodities. There's that drop in the energy prices. Crude oil down 20%, still up 40+% on the year. Silver and gold started the year ripping. They've pulled back now down on the year, and then kind of a mixed bag for the rest of the commodity complex. Economic data-wise, manufacturing and services PMI both over 50, meaningfully over 50. Manufacturing has definitely seen a renaissance with the big capex investment after spending much of 2022 through the end of 2025 in negative territory, sub 50 being negative or not growing, and now doing really well. And globally, we saw that the world, and I believe that's China, Euro area, in the dark blue, so many colors, hard to see sometimes, were negative. Now they've actually picked back up too. This is, I think, just the global capex boom that we're seeing right now. So doesn't seem like we're near a recession. Employment looks okay. Unemployment actually ticked down. Here's services PMI, same concept. I guess Germany was down sub 50. That's picked back up. Atlanta GDP now, big revision lower, but we're still positive real GDP estimate for the next quarter. And here we can see rates. So been a big repricing of rates. It's all about the new Fed chair. He's going to fight inflation. He's going to fight inflation. He said it multiple times at the press conference. And so on that news, you've seen a flattening of the curve, the long end kind of holding steady, and the front end repricing to now pricing in a couple hikes. And I don't know. I think inflation is definitely coming down. Core CPI is going to come down. I think he wanted to make a statement that he is, there's going to be credibility at the Fed, but at the same time, he's got these task force that are looking at different things at the Fed, like the forward guidance, the dot plots, the way they calculate inflation, the different inflation metrics they look at. And I think he even said it's going to take time for those task force to do their job, and that I don't think he's going to do much until he gets those results, and that gives him time to be patient and wait and see what happens with the inflation data, and there's definitely a chance that it could ease, and they could. I don't think they're going to cut, but they could be more neutral, and I think that would cause the market, the front end, to rally a little bit. And then on the long end, you still have some fiscal concerns globally. Japanese long bonds, the 30-year JGBs, sold back off towards 4%. They've caught a bid recently, but I think we've seen a little bit of a backup in our long end with those JGBs selling off. So that's something to watch. Fiscal concerns coming back into play, Social Security, things like that. Nobody's talking about it right this second, but just give it some time, and some of those concepts will come back to, I think, come back to roost. Here you can see the flattening of the curve, especially 230s had got out to like about 120. Now we're sitting about 86 off the recent lows. But the one thing that's good for the market is that concerns around inflation have eased. You can see there was a big spike in short-term inflation expectations, even 5-year inflation expectations, and everything is coming down now. And a lot of this is directly correlated with energy prices, but this is good for risk assets as the market believes that inflation, at least over the next 2, 5, and 10 years, will be around that 2% area. So on that note, looking at fixed income, this is the month of June, positive returns across the board, not crazy positive, but looks like shorter stuff doing better and shorter credit doing better. Triple C levered loans, which had lagged, up 40 basis points. The ag up 20 basis points. Floaters here, CLOs up 40 basis points. EM sovereigns up 70 basis points. And now year-to-date performance, 2026 through June 30th, the ag up 60 basis points. Again, the winner being shorter floating rate stuff and credit. Riskier credit, the better, because investment grade credit has duration. You can see investment grade corporate bonds only up 90 basis points, where you have the high yield index up 2. Bank loans, which started the year lagging, up about 1.4. But the risky stuff in the bank loan market not doing well. So a lot of the risks in high yield refied into the bank loan market, and it's got some more troubled credits there. That's why it trades at a wider spread than the high yield index. And you can see the triple C component of the levered loan index is the underperformer, down 3% on a year where stocks are winning, commodities are winning, and bonds are earning their coupon, basically. Spreads, a little bit wider, again, in the bank loan market. Legacy RMBS, I don't know where we get this data, but I don't think it's 20 wider, but have to check with my team on that. And triple B CLO is a little bit wider, RMBS, AAA is a little wider on supply, but basically not much. 10 basis points of spread widening doesn't move prices too much for those short duration assets. Here you can see a little glimpse of spread widening, a lot of it on supply, tons of supply in the IG market, a lot of supply coming in the high yield market, pushing spreads wider, but still near their historical lows. And here's the what looks cheap report. Mortgages and securitized still on the cheaper end. Corporates back down the bottom near their tight levels. Bank loans looking cheap to high yield. So, there's opportunities out there. It's really about bond selection, the kind of easy beta money, just when spreads are wide, buying low-cost ETFs and just riding the spread tightening. Like, that's over now. Now you got to be kind of picking and choosing your credits and finding opportunities and in certain pockets that we see like technical weakness, like RMBS right now. We just got a ton of supply before the fourth, push spreads out a little bit. But that's the update for this month. Good luck out there. I'm sorry to see the U.S. men's national team out of the World Cup, but we've got some exciting games coming up, and I think the market's been a little sleepy because people are watching a lot of football out there.